Hey, savvy investors. Thanks for tuning in. Welcome back to Why Invest Capital, where culture meets capital and future moves are decoded in real time. I'm your host, Nicholson, laying down strategy with swagger. Got my A team here, Brian, our investment strategist. What's good?
Insights with impact. Let's get it.
Segment 1. What exactly is the Genius Act and why?
A power move, the Genius Act. When government jumps in on digital money, it's not just law, it's a power play. Coins are transforming the speed, infrastructure, and control of money. This is more than crypto. The Genius Act just cleared the Senate, like legit legislation. This is the US government making its first real official move on stablecoins. But make no mistake, this is serious policy with serious money on the line.
For folks who don't know, stablecoins are digital assets pegged one-to-one to fiat currency, usually the US dollar. Stablecoins stay level. They move fast like crypto, but hold value like cash.
But the catch was, before this bill, they were running wild, no rules. So Terra/Luna was the poster child of that chaos, and that collapse cost people billions.
Yeah, that's why the Genius Act hit different. It basically lays down three critical foundations. One-to-one reserves. Every stablecoin has to be fully backed by either cash or short-term US Treasuries. Transparency, regular public audits. You can't hide funny math. No algorithmic stablecoins. If your coin's backed by vibes and formulas instead of real dollars, you're out.
Stablecoins aren't just niche anymore. The market's already moving over $230 billion, and it's projected to hit $1.6 trillion. That's real flow.
Plus, America's got to play defense. Other countries are launching digital currencies. China's already piloting theirs. If stablecoins go global and they ain't dollar-backed, the US loses leverage on global finance.
So this act ain't just regulation, it's geopolitical strategy.
A digital dollar arms race.
Here's the key takeaway for our listeners. The Genius Act legitimizes stablecoins. That opens up infrastructure, compliance, and capital.
So now that Uncle Sam just dropped the regulatory cosign, Wall Street's investing. The Genius Act didn't just create rules, it created winners. Some crypto native players just went from maybe to must watch.
Compliance is now clout, and no one's flexing cleaner compliance than Circle, the folks behind USDC.
Circle's been the clean-cut kid of crypto. Their entire model is built on transparency. They hold US Treasuries, they publish monthly audits. Genius Act basically validates their whole playbook.
Circle's set up to rake in big revenue just from interest on the reserves they hold.
Don't forget their bestie, Coinbase. They're partnered, they're tied in. And USDC is making Coinbase a lot of money, especially with trading volume expected to climb with more investor trust.
Coinbase holds a stake in Circle. Most people still think of Coinbase as just an exchange. It's evolving. They're building infrastructure, wallets, custody, developer tools, the plumbing of this new financial system.
And let's not ignore the public markets. These aren't back alley crypto firms anymore. They're on the NASDAQ. They're getting analyst coverage, hedge funds, pensions, family offices. They're watching now.
And with the Genius Act giving the thumbs up, the institutional money is about to stop lurking and start moving.
So here's the quick play for investors tuning in. Companies that were already regulatory friendly now have first mover advantage. Their growth ain't hype, it's infrastructure. If this space scales, we'll scale with it. Some big players are circling this stablecoin space. Let's get into segment 3.
Segment 3. Traditional financial institutions, friend or foe?
All right, big banks, JP Morgan, Bank of America, Citibank.
The stablecoin space was messy. But now, with one-to-one reserves and transparency legally baked in, the banks see opportunity. Think about it. Instant settlement. No wire transfer delays, lower costs, more liquidity. That's a dream scenario for traditional finance. Plus, the Genius Act gives them a framework to build their own stablecoins. JP Morgan already has JPM Coin. And that creates a whole new game. Because now it's not just Coinbase versus Binance. It's Circle versus Citi. stablecoin 2.0, but here's the tension, and it's real. If stablecoins become too good at what they do, they start cutting into the cash cows of big finance, like credit card fees, ACH charges, and foreign exchange spreads.
If your stablecoin can move money globally in real time for a fraction of the cost, Visa, MasterCard, and the entire payments industry might be shook.
You've got banks deciding, do we build with the crypto folks or compete against them?
Disruption creates winners and new markets. Banks adopting stablecoins might drive more volume, more use cases, and more retail awareness.
We might finally see banks start competing on innovation again, not just who's got the fancier app.
Segment 4, The Ripple Effect, Fintech and Beyond.
Fintech been on the block, already remixing how we save, spend, and send. Now that the Genius Act's providing guardrails, these innovators are about to put the pedal down.
Think Cash App, Venmo, Stripe, PayPal. They've already been flirting with stablecoin tech. PayPal even dropped their own, PYUSD.
Let's be real. This is where things get real global, real fast. Stablecoins are borderless, instant, and liquid. That means people in Nigeria, India, Brazil, anywhere struggling with inflation or banking access, can now hold digital dollars.
Being able to hold a US dollar on your phone without a bank account is game changing. This isn't just fintech, this is financial inclusion with teeth.
Now throw in DeFi, decentralized finance, liquidity pools, lending protocols, tokenized assets.
Picture this: a fintech app in Kenya lets a user earn 4% yield on stablecoins collateralized with US treasuries, auto converted to local currency only when needed.
Inflation's going to be watching closely. This bill is just the start. More frameworks will follow for wallets, apps, even smart contracts. Not coins, not blockchains, but infrastructure companies that simplify crypto for the masses.
Now, before we get too starry-eyed, let's get grounded. There are real risks in this space. Don't let the headlines make you forget. Risk is always part of the recipe.
Let's start with the basics. These ain't FDIC-insured dollars. If a stablecoin issuer fumbles the bag, your digital dollar could disappear faster than a meme stock on a Monday.
Even with this new regulation, stablecoins are still not bank deposits. If the issuer fails or the reserves are mismanaged, you could be left holding the bag.
And this space moves fast. Even legit projects are vulnerable to hacks, smart contract bugs, tech failures, one rogue line of code, one security slip up, boom, millions gone. That's not fear, that's history.
Concentration risk. Right now, Circle and Tether dominate the stablecoin game. If either of them takes a hit, regulatory or reputational, it sends shockwaves through the whole market.
Think about it. If stablecoins balloon to $1 trillion and are holding all these short-term treasuries, what happens to the bond market if people panic and try to redeem all at once? That's liquidity risk with real teeth.
Algorithmic stablecoins, still banned under the Genius Act. Someone out there is going to try to bring them back.
Stay diversified, and always remember, new systems come with new forms of risk.
Investing in innovation doesn't mean ignoring danger, it means understanding the terrain. Stablecoins don't just chill in digital wallets. They sit on top of a whole lot of US treasuries, short-term government debt.
Every time someone mints a new stablecoin, they gotta lock up an equal dollar amount in assets, usually US T-bills. Multiply that by billions, and suddenly you got a whole new buyer in the bond market.
This demand could drive down short-term treasury yields.
But it ain't all roses. The Fed's job, controlling interest rates and inflation. If stablecoins start pushing too much money into the system, the Fed could lose some grip on short-term rates.
Plus, with this much treasury exposure, stablecoins start to act like money market funds. And if things get shaky, people might rush to redeem stablecoins all at once.
That's massive bond selling. Could ripple through markets in ways we haven't seen before.
So for investors, if you're in bonds, especially short-term ones, this regulation could mean more price stability. but also more players in the sandbox.
Stay nimble, diversify smart. Crypto adjacent stocks are still stocks. Balance is key. Look under the hood. If you're into a company touching stablecoins, check their reserves, audits, and real world partnerships. Stay long term.
Keep watching Circle, Coinbase, PayPal, and the new fintechs building in silence.
Who still think stablecoins are just stable and subscribe. Because don't forget to mind your business. Until next time, keep stacking knowledge like compound interest.